Hello, everybody. This is Michael DeGioia joining you from the Trader Newsroom. How much lower will the market fall this autumn? That's the question on everybody's mind as the markets are currently dropping as we speak. My name is Michael DeGioia. I'm Director of Educational Services and licensed professional here at Trader, and I'm joined by my co-host, Jill Molandrino, Global Markets Reporter from Nasdaq. Jill, how are you?
Good, doing well, thank you.
You're there at the market site.
I am.
What's the feel from the center of the Nasdaq market as the markets have dropped pretty precipitously, pretty much this week?
Yeah, well, it's September certainly coming to a close tomorrow, the end of the third quarter for 2022, and certainly living up to its reputation of being the most volatile month of the year. It's really hard to find bright spots in the market, and of course, over the past 4 to 5 weeks we've been in an earnings vacuum. So even if you look at the action that we saw on Tuesday and Wednesday, open down in the morning, up in the afternoon, or vice versa, because the market is so predicated on what's happening in the headlines, we should expect to see some relief in October through mid-November when earnings season kicks in earnest. But even still, who knows what that corporate news is going to look like and what forward guidance looks like. We saw what happened with Apple this week, and if that's any indication of how investors are going to process any sort of dialing back with guidance, earnings, profit, revenue expectations, it's not exactly the best thing to predicate it on. However, and then also at FedEx too, we saw the reaction to that. So even to say we're in a corporate news vacuum, the news that does trickle in throughout September has not been good, and we've seen how investors have reacted to that.
Got it. Yeah, no, I totally agree. I mean, we saw the jobless claims numbers, which should have been, interpreted. I call this bizarro world. I mean, where what is good news is bad news, and bad news is sometimes considered good news. But the jobless claims hit a 5-month low. Regardless of that, now the expectation in this bizarro world that we live in is that because the jobless claims was far lower and has been still pretty robust, that the likelihood of another large rate increase on November 2nd is conceived as that's a possibility or a higher likelihood. So when will the job market and the economy? So it might already be doing so, but the question is how will the Fed react? And now the entire market seems to shift based on what the Fed's reaction is going to be to what could be perceived as good news, rather than reacting to the actual good news.
Right.
So what are your thoughts on that? I mean, it's kind of like bizarro land.
It really is. And I feel like this conversation has come up a number of times over the past couple of weeks. The Fed has an impossible task. Now, whether or not you think their strategy is correct at this moment in time, you have to consider the backdrop that they came from, right? Historically low interest rates, liquidity in the system. We've been pumping liquidity in at least for the past 12 to 13 years, certainly since the great financial crisis, and certainly since 2010. So you have a market that is lacking in any sort of patience to allow policy to play out. I think another problem that the Fed has is that it is data dependent, and the data that they really rely on, which is inflation and jobless data, it's a backward looking thing.
Yeah, it's lagging.
And also the surveys and the data that they use are actually, they will send surveys out to market participants such as economists or other experts within the labor field. So it's not real-time data that they're looking at, and it's also almost conjecture coming from other surveys and boards and economists and so forth. So it's not an actual real look, which is interesting to me because there are a couple of platforms that do real-time data analysis. For example, like when you go to the grocery store, they could look at millions of SKUs daily and see how prices fluctuate. So I feel like when you're looking at stuff that is a month or two backward looking, it's not moving along with what we're seeing day to day. So I feel as if this data dependent strategy, they might need to think about being a little bit more flexible, and at the same time investors need to be patient. Markets move off of headlines. The economy does not work like that. So I think you have a confluence of all of these factors, and you have a mindset of investors who were rewarded instantaneously for over a decade. So I think, we need to remember that this could be a 12 to 18-month process, and the market is not the economy.
Yep, absolutely. I think that's a very good point, that there is a factor of lagging data, that the data that the Fed is looking at is all this lagging data. Maybe they haven't kept up with the times in terms of better data sources that are a little bit more real time. Yeah, and that's an interesting point in this age where data seems to be everything. Very interesting. The stock market has already come down from its highs. The big question here, I've heard a lot of, and pretty much everybody, not everybody, but many analysts and famous market pundits from, we talked about last time was, I guess it was Ray Dalio and a couple of others, have come out saying that the market is ready for a 20% correction or a 10% correction or a 30% correction. From here, the market was down precipitously this week. It looks like we broke the lows today, which is Thursday, the 29th of September. This will be aired tomorrow on the 30th. Looks like we're breaking the lows. Maybe we'll snap back tomorrow on Friday. The question is, how low do we go? What are your thoughts from consensus of the people that you've spoken to?
Yeah, well, you know what? It's interesting. When we were talking about this, when we came off in June 2020 lows, when we had that move in July and August, you and I were saying, it's interesting that this market is trading as if the Fed is going to reverse policy and interest rates are either going to stay where they are or move lower, because we just had that enormous move up. And prior to that, we were discussing how, well, this isn't over until we see that massive flush. So perhaps this is that flush that we're seeing. We can't string together a series of green days. We had one yesterday, and while, I don't want to say a healthy market, but in a more normal sense, markets don't have extreme moves by 2, 3, 4% each day. So that this is not over, in my opinion. I think we have to get through earnings. I think the midterm elections are certainly going to have an impact. But the fact of the matter is there's a lot of negative news out there. And you just have to think about, what's your time frame like? Are you a day trader? Are you a swing trader? Are you long-term investor such as myself, where this could be a generational opportunity, just like it was when we saw the March 2020 lows during the pandemic. So
certainly,
it depends on your perspective, how you are positioned, of course, and what your time frame is. You could wake up short in the morning and look at the reversal that I think it was Tuesday that we had.
Yep.
Tuesday or Wednesday.
Sharp moves. No doubt. So I think the one thing is here to stay. Certainly the volatility seems to be here to stay. We have a lot of volatility creating events in the near term horizon, one being the midterm elections. But we go through the list. We had the and this is something I wanted to bring up. There is the we have the the confluence of so many different pending potential problems and or existing problems. We have a massive storm in Florida. We have a new prime minister in Italy that could be potentially the next Brexit type situation, with Italy pulling out of the European Union. Potentially, it's not being spoke of yet, but there was a massive crowd that within 2 or 3 hours of Meloni's being elected, new prime minister Meloni being elected, they had already pulled down the European Union flag in Rome. So the question is we got uncertainty in Italy, bringing uncertainty to the European Union. We have all kinds of Bank of England, policy changes and various different banking maneuvers that so far have not seemed to shore up the British pound. We have the North Sea. We have in the Baltic Sea. We have the Nord Stream 2, burn going on, where you basically have, natural gas, flooding into the Baltic Sea. We have all these points of uncertainty. It seems like one thing is for sure is that we can all agree on that we have a lot of volatility, at least in October and November. Would you agree that that's the one constant that we have here? And probably just caution is the best recommendation for anybody at this point.
Yeah, I would agree wholeheartedly with you. As I had mentioned, until we see consistency with being able to string a couple of up days together, or at least a market where we're not seeing extreme moves to 1, 2, 3, 4, 5%. I think we're looking at now. Well, the markets came back a little bit, but you have, if Nasdaq 100 was down over 4% this morning, but until you stop seeing these extreme moves, the up or downside, not even just for a session, but intraday as well. That shows you that there's not much conviction in there. And I think that is what investors are waiting to see, a more normalized market. I think, out of, you're looking at geopolitics, the Fed, inflation, doubt in the Fed strategy, still supply chain issues, or any one of these could be a market moving factor. I mean, what's happening in the FX market and the dollar, I mean, that could be a conversation in its own, but they're all happening at once. I don't see how in the short term, how any single one of them will be remedied, but it's hard to find bright spots right now.
At the moment, yeah, things are looking, pretty uncertain. I mean, the thing that stood out to me, and I wanted to ask you about this, was relating to Apple.
Yeah.
Apple, had been the leader of the market on the way up, and it makes up a huge percentage of the QQQ, which is the Nasdaq representative of the Nasdaq 100. With Apple getting smacked, for almost 4% at the open yesterday, and then it did come back quite a bit. Then of course it was back down again today. Is that usually is a sign that that their markets don't all go up, and bull markets don't unwind in a moment. They have segments of the market. So when the leaders start to show weakness, what does that generally mean for the markets overall? From your perspective, it tends to be a little bit more of a fundamental perspective than me, who tends to be a little bit more technical. So what are your thoughts with Apple? I mean, going out into the future, what does that indicate for the NASDAQ overall?
Well, you know what? It's so interesting because I feel like we go through this with every cycle, or certainly at least once a quarter, where, we hear they're, asking suppliers to dial it back a bit, or there's concerns with demand. I mean, I don't know anyone who's gotten the new products yet. I think the 13 or whatever the most technical, the new phones, I'm sorry, the most technical, the new phones, I mean, you can't even get them, they're on waiting lists. So I don't think it's a demand issue, but I feel like this happens quite frequently with Apple. I mean, there's always going to be the risk to the market just because of the weighting that it has in the Nasdaq 100, the S&P. I mean, it's in virtually every broad-based
pension fund, right? Everybody has Apple.
It has to be owned. For every broad-based index, it's in there, whether you're looking at tech, whether you're looking at consumer, whether you're looking more on a macro level. You could throw in ESG funds have to own it. So but yes, of course there's going to be that risk because as goes Apple, it does move the market.
Yeah. So for me, though, it was a little bit of interesting because I kind of felt like, I have an iPhone 13 Pro Max, right? And in thinking about, getting a new iPhone, I'm like, this one's great. Like, how much better can it possibly get? It's such an amazing phone. I mean, that's a little bit of a problem overall, though, a little bit longer term for Apple is the product has gotten so damn good. I mean, it's really hard to get much better. So, that was like my thing was like, I'm not going to go get a new iPhone 14 when I have this one and it's so good.
Yeah. Well,
that's kind of like,
I'm sorry.
What?
Anecdotally, everyone says that. And then you don't really get it anyway, because you have that FOMO sort of mentality, especially for people who use it for creative exercises such as, production, social, whatever. And they use it. For me, I'm just cheap. I'm going to wait until this thing dies. I have the 12. But there's never going to be a demand problem with that.
No, I guess not. I just my thought was, it's kind of like, with Netflix, we saw that, that they ran into this subscriber problem where they kind of ran out. I mean, most of the world pretty much had it. Most of the world that was going to get Netflix already had Netflix. So then therefore they had a drop in subscriber growth. So I just thought if that was a kind of similar problem for Apple, in that the technology has gotten so good. There wasn't really, I didn't see any real significant benefit. The camera's a little bit better, but it's not significantly better. So, and that could be something that we're just running into at the end of this tech cycle, meaning that technology has gotten it's improved so much in so many areas that, you know, the technological improvements are not moving by leaps anymore. We're kind of moving by increments, you know?
Well, you know, I'm going to counter that. One thing, the difference between Apple and Netflix is Apple is a brand, and it's considered, I guess, a luxury brand, if you will, within the consumer space. So it's always going to be, especially for younger generations, like I have to have, you know, the Apple iPhone, and I don't think that's ever going to go away. And yes, you're almost like, oh, what can be next? What can be next? But there are things coming next. How are phones going to integrate Meta and Web3 experiences, and you know, how will virtual applications be on the phones and so forth? So right now, as it stands, it might be okay, what's new, but there's a whole technology shift that's coming across the board. So it's really going to be what that experience looks like. So you're going to, at some point, if you want that experience, you're going to have to, I mean, I think that's kind of cool. I mean, what are these? I think, you know, the fraction of the use cases that you have for an iPhone are being applied, and it's only just going to exponentially get bigger. How will the ecosystems change, you know, as these new apps and technologies come online? So there could be something to look forward to.
Yeah, I mean, you know, it's funny you should mention that, because I have like 2 apps on my phone that I never imagined would be on my phone. One that scans plants and tells you what species it is, if you like want to know what kind of plant is in your garden. And the other one is one that scans rocks and tells you what, you know, what kind of minerals are in the actual rock. I mean, these are things that I would have never imagined, and it's kind of like Star Trek, like the what was the thing that they used to use in Star Trek where they would scan things. But yeah, you're right. You never can imagine what's coming out until it actually does come out, and what the new use is until it actually, you know, starts to be implemented. And the use that we're doing with our iPhone is a fraction of what it's capable of. So you're 100% right in that. Well, that moves us on to the market analysis section. And thank you so much for joining us, Jill. As always, great insights.
Thank you. All right. Take care, everyone.
Look forward to seeing you. Bye-bye. Thank you. All right. I'm going to jump right to market analysis here. And we're going to take a look at the charts right as the market is closing up on this Thursday. We're gonna just pop this open, make it a little bit bigger. I'm going to go to the daily chart. We can see that we were down pretty precipitously in the morning. This is the intraday chart on the S&P. We bounced from there, and then we kind of pretty much made a slightly lower new low into the afternoon. You know, we're kind of hovering right here at the 362.75 area, 362.79 area, but we so far have held, unless we gap down, you know, which we could do certainly. We are kind of holding off at these levels, but I mean, it's very possible that we gap down. The Nasdaq is closing below. This is the QQQ. It would be closing below the prior low, which is actually a pretty bearish sign. If we go to the intraday just to get a feel for that, we have bounced pretty significantly off the low, meaning that we were lower, and we've come from you know, 269 back up to 271.50. Here is the DIA. DIA pretty much did the same thing. DIA held the low that was established on Wednesday. So the DIA showing a little bit more relative strength than the NASDAQ. GBTC, our old cryptocurrency ETF tracking stock, looks like it might be in the midst of a breakdown at 11.37. ETHE. Ethereum also showing a fair bit of weakness at 9.10. This is ETHE. This is the Ethereum tracking stock. Let's take a look at the old man gold. Gold certainly on the upswing. The dollar has come off a little bit, and gold is showing some strength as a flight to safety occurs. This is GLD, the gold tracking stock. USO. Okay. USO is another one that we're keeping an eye on. Obviously, it was down pretty considerably when the interest rate announcement came out. We have since rallied a little bit, but we are off the lows as oil starts to strengthen. USO is the oil tracking ETF, so that's another one that we tend to keep an eye on. Going down the line, let's take a look at the big one, Apple. I mean, Apple really is the one that led the markets down today. We pretty much had that bad news come out on the slowing of production or reduced expectations for the buying of new Apple iPhone 14s. That gapped the market down. There was a pretty nice rebound after that. And then we had the secondary gap down today. We've since sold off. Let's take a look at the daily chart. I mean, on Apple, you could potentially run all the way down to 120. Now, we are a little bit oversold at this point, but again, we don't know what's going to happen. Nothing has to stop until it actually stops, but Apple certainly leading this charge to the downside. Tesla also breaking down today. Tesla had made a nice rally up, but it looks like it might be in a downward swing as well. I mean, it had a really bearish day today, dropping from 285 down to 268. So that's a significant move to the downside on Tesla. And I'd be a little concerned with that. Just based on this chart, you got a high, triple top, lower high, and then a drop. We haven't quite broken the low, but it looks to me like there could be significant movement to the downside. Microsoft also holding the low, somewhat like the Nasdaq. I mean, these are all the big name stocks. Even Netflix we mentioned today seems to be contrary to that, since it's already down so massively. It's kind of holding pretty firm. So a lot of weakness in the market. Remember, it is also into the window dressing time of year. So you could get some window dressing, meaning you could do some extra selling today and tomorrow with a rebound thereafter. Okay. So on that note, I'm going to jump back to the charts, back to my my slideshow presentation, and just mention about our swing trading competition. So registration is still open. You can use code DAS30 at checkout today. That's DAS30 at checkout to save 30% off your registration price, $30 rather, off of your registration price. Registration and boot camp runs through October 2nd. Competition runs for 20 trading days. That's from October 3rd to October 28th. The prizes include up to 9 months of access of the DAS Trader Pro platform. All winners will receive a private tour of the Nasdaq Times Square market site. That's where Jill was today. We'll actually be there next week as well, giving a tour from some past winners from during the pandemic. You can visit numberonebesttrader.com to learn more. For our full market site tour details, just go and visit onebesttrader.com. Certainly keep up to date with all things DAS. Stay up to date with everything DAS by signing up for our monthly newsletter and our email. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel at DAS Trader TV. And for the DAS Newsroom reminders, you can hit the little bell there, and that'll give you the reminders on via YouTube. Follow us on social media at dastrader.com, at DAS on LinkedIn, Twitter, Facebook, Instagram, you name it, we're out there. Anyway, everybody, be cautious. The markets are going to stay volatile for a while. Certainly trade well. I look forward to seeing you in the upcoming competition. See you in 1 week, because as the competition starts, we start to give you, the show goes every week. As the competition continues, it's also live during the competition. So for the next 4 weeks, we will be live doing a show each and every week. Thank you for joining us, and see you next week.